The global financial system moves like a massive machine, quiet, complex, and largely invisible to the average person. Most people live their daily lives unaware of the subtle shifts that take place behind the closed doors of boardrooms and private wealth offices. But the richest people in the world, the billionaires, whose empires stretch across continents, are never unaware. They see the tremors long before they become earthquakes. Their money doesn't just buy luxury, it buys information, access, and insight. And now, something unusual is happening. The world's billionaires are selling. Not a little, not modestly, but tens of billions of dollars. Fast, quietly, aggressively. It begins with whispers on trading floors, small notes passed between analysts, and abrupt changes in the portfolios of ultra-high net worth individuals. At first, it looks like coincidence. One billionaire cashes out a large position, another sells a block of shares, a third offloads real estate. But within months, the patterns become too obvious to ignore. Tech founders, hedge fund titans, industrial magnates, members of the global elite from Silicon Valley to Dubai to London, all reducing exposure, all liquidating assets, all making the same move, converting stocks, properties, and private investments into hard cash. To ordinary investors, this looks strange. After all, markets are still hitting all-time highs. Financial news outlets continue to project optimism, encouraging everyday people to invest more, to buy the dip, to trust the system. Governments insist that growth is strong. Banks maintain that inflation is under control. But beneath the surface, the billionaires see something else, something that the public won't understand until it's too late. This is not panic. Billionaires don't panic. This is preparation. Throughout history, the wealthy have always acted early. Before the dot-com crash of 2000, several major tech insiders quietly sold shares months before the bubble burst. Before the 2008 financial crisis, real estate developers and hedge fund executives pulled capital from mortgage markets and banking stocks. Before COVID-19 shut down the world in 2020, a handful of the richest individuals reduced their exposure to airlines, hotels, and commercial real estate. Now, in 2025, the pattern is repeating, but this time, the scale is much larger, more than $50 billion in assets shed in a single wave. Why? The answer isn't simple, because the warning signs are not coming from one direction. They're coming from all directions. Markets have expanded too fast. Debt has piled too high. Geopolitical tensions are intensifying. Banks are tightening lending. Tech valuations have soared far beyond what earnings justify. Global housing markets are straining under the weight of speculation. And inflation, though officially reported as under control, continues to reshape the real economy with rising costs, shrinking margins, and declining spending power. Billionaires understand that economic crashes rarely begin with one dramatic event. They begin with small cracks, tiny fractures spreading silently through the foundation until one day the entire structure collapses. They understand cycles because they have lived through them and profited from them. They know that for every boom, there is a correction. For every surge, there is a fall. For every peak, there is a turning point. The average person sees the boom. Billionaires see the turning point. In private rooms filled with data scientists, economic forecasters, and geopolitical advisors, the ultra-rich receive early warnings. They watch the same charts the public never sees. They analyze money flows in real time. They track corporate buybacks, insider selling, commodity shipping volumes, supply chain disruptions, bond yields, and central bank policy trajectories down to every decimal point. They don't wait for a crash. They position themselves before it happens. And right now, they are moving to safety. Across the United States, the signs intensify. Tech CEOs sell shares of their own companies, sometimes more than they sold in the last 5 years combined. Venture capital firms quietly slow their investments. Hedge funds shift billions into cash, gold, and short-term treasury bills. Ultra-luxury real estate, once a favorite billionaire playground, begins to experience a silent exodus. Mansions, penthouses, and investment properties listed discreetly, sometimes off-market, but always at discounted prices designed to move quickly. It's a liquidation wave, but not a panic sale. It's strategic, controlled, calculated. In Europe, the same behavior appears. Wealthy families in Germany, France, and the UK convert assets into liquidity while private banks record an unprecedented rise in cash positioning. In Asia, billionaire investors in Hong Kong and Singapore pull money from riskier markets. Even in the Middle East, normally insulated from Western volatility, sovereign wealth advisors urge caution. Every continent, every sector, every class of elite investor, the same pattern. But people ask, if everything looks fine on the surface, why are they selling? Because the surface isn't reality. The real signals are buried deeper. Corporate earnings are stagnating while stock prices remain inflated. High-growth companies are losing momentum, but still trading at extreme valuations. Banks face rising delinquency rates on credit cards, auto loans, and commercial real estate. Small businesses are increasingly dependent on debt to survive. Governments are relying on loans to fund basic operations. And central banks cannot cut interest rates fast enough without triggering inflation all over again. The billionaires see a system stretched to its limit, and they know that when the system reaches breaking point, liquidity is king. During every major economic downturn, those with cash don't just survive, they acquire. They buy undervalued companies. They purchase distressed real estate. They pick up assets at fractions of their true worth. Crashes aren't disasters for them. They are opportunities. So when billionaires sell everything, it is not fear. It is positioning for the next cycle. As the documentary continues, we explore the psychology behind these decisions, the historical patterns, and the global triggers that could turn this $50 billion warning sign into a full-scale financial reckoning. Because the question is no longer, are the billionaires selling? They already have. The real question is, what do they know that the world doesn't? And as we move deeper into the story, the answers become clearer, more unsettling, and more urgent. The warning signs didn't begin with headlines or breaking news tickers. They started quietly, almost silently, in the private offices of the world's wealthiest individuals, rooms where billionaires meet with advisors, analysts, and strategists who speak in whispers, not alarms. These are people who look years ahead, not months. People who measure risk not by fear, but by mathematics, behavior, and probability. For them, selling isn't panic, it's preparation. Throughout history, the richest individuals have always moved before everyone else. In 2007, as global markets appeared unstoppable, a handful of insiders began unloading assets long before ordinary investors even sensed danger. In early 2000, tech founders and venture capital giants quietly sold shares weeks before the dot-com bubble burst. Today, the same pattern is repeating itself, but on a scale far larger than before and far more coordinated. Over the last year, insider selling from billionaires has crossed $50 billion. This isn't the typical, predictable, quarterly selling for diversification or tax planning. This is something different. Concentrated, accelerated liquidation. Tech moguls, media emperors, retail giants, hedge fund titans. Many of them are stepping back at the same time. For the average observer, it appears random. But behind the scenes, a clear pattern emerges when the numbers are placed side by side. It begins with the corporate environment shifting. Companies that once reported record profits suddenly speak of uncertainty. Earnings calls filled with optimism begin using words like volatility, slowdown, correction, and adjustment period. These words may seem harmless, but in the financial world, vocabulary is a form of code. When CEOs speak publicly, they choose their words carefully because markets react to every syllable. So when multiple industry leaders adopt the same careful language across different sectors, technology, manufacturing, real estate, finance, it sends a signal that something is moving beneath the surface. Then comes the next stage, asset rotation. Billionaires shift their capital from public markets into safer spaces, short-term bonds, cash reserves, private equity deals with guaranteed yields. They begin reducing exposure to long-term liabilities. Luxury real estate starts hitting the market in clusters. Private jets and yachts quietly change ownership. Stock option exercises spike as insiders convert paper wealth into liquid assets. They don't announce these choices because they don't need to. Their actions speak louder than press conferences ever could. The public, however, sees none of this. Most people only notice when the numbers reach the headlines, long after the selling is already complete. But the wealthiest operate on a different timeline. Their decisions are based on signals invisible to ordinary investors. Credit tightening, liquidity shifts, bond market inversions, margin debt patterns, and global capital flows that move silently across borders. As selling accelerates, market analysts begin to speculate. Some believe billionaires are simply taking profits after years of market growth. Others argue that taxation changes incentivize selling. But behind closed doors, financial advisors warn that the economy may be entering a new phase, one defined by overstretched valuations, excessive debt, geopolitical uncertainty, and slowing corporate earnings. The truth is, the global economy has been running on borrowed time. After years of stimulus, cheap money, and artificially low interest rates, the system has grown fragile. Every layer of the economy, from households to corporations to governments, has taken on more debt than at any point in history. This creates a delicate balancing act. As long as money stays cheap and growth continues, the architecture holds. But when interest rates rise, profitability declines, or geopolitical shocks hit, the structure begins to shake. Billionaires understand this because they have teams of experts monitoring every shift, every anomaly, every early tremor. They see trends months, sometimes years, before the public does. Their portfolios are structured to respond to silent dangers long before those dangers become news stories. In private meetings, analysts warn that the global economy is approaching a critical threshold. Supply chains have not fully stabilized. Inflation, though slowing on paper, continues to pressure companies behind the scenes. Energy markets fluctuate unpredictably. Real estate bubbles form in key cities, while commercial properties face historic vacancy rates. Manufacturing slows, consumer spending weakens, and tech, once unstoppable, shows signs of saturation and fatigue. When billionaires see these signals, they act. And this time, they are all acting at once. Their selling indicates not fear, but strategy. They reposition before risk becomes visible. They retreat from markets before the first cracks appear. They know that downturns don't begin with sudden collapse. They begin with slow, quiet shifts in behavior that only experts notice. Meanwhile, ordinary people continue their routines, unaware that the financial landscape is changing under their feet. They see stock markets hitting new highs and assume everything is fine. They listen to the optimistic broadcasts, unaware that markets often rise the most right before they fall. The illusion of stability holds until it doesn't. In hedge fund offices, analysts debate the timeline of the next major correction. Some expect it within a year, others within months, but none deny its likelihood. The question is not whether a downturn is coming, but how severe it will be and which sectors will be hit first. For now, the markets remain relatively calm. Indices rise, investors remain hopeful, but beneath the surface, the people with the most to lose and the most knowledge are quietly stepping back. Their actions create a shadow warning far louder than any speech or forecast. Selling is not simply a decision, it is a message, a $50 billion message. And the world has not yet understood what it means. Across global markets, a strange and unsettling pattern continues to unfold. Billionaires, people celebrated for their uncanny ability to predict future trends, are no longer just trimming their portfolios, they are accelerating their exits. What began as a few isolated sales has now become a tidal wave of liquidation, moving quietly through trading floors, private equity rooms, and offshore accounts. The public sees only the surface-level headlines, but behind the scenes, financial analysts, investment firms, and central bankers are piecing together the same alarming puzzle. Something bigger is coming, and those at the very top are positioning themselves before anyone else even realizes what is happening. In Wall Street boardrooms, whispers spread about unusual block trades executed after hours, massive volumes of shares sold in single strokes to prevent market panic. These are not retail investors reacting emotionally. These are founders, Fortune 500 CEOs, and private equity titans who spent decades building these companies now stepping away with remarkable speed. Their timing raises eyebrows, their patterns raise fear, and their silence raises questions no one can yet answer. Some attribute the sell-off to rising interest rates, the force that has historically acted like gravity on inflated markets. Others blame geopolitical instability, the growing turbulence across supply chains, and the shifting balance of economic power between nations. But beneath all these factors lies a deeper, more unsettling truth. Capital is fleeing risk, and billionaires, those with access to the most advanced financial models, the earliest data, and the most private intelligence, are acting as though the global economy is approaching a turning point. Inside private banking circles, advisors report unprecedented instructions. Clients worth hundreds of millions request full portfolio reviews, liquidation options, and relocation of wealth into assets traditionally reserved for crisis periods. High net worth individuals who once relied on stocks and real estate as their wealth engines now chase security over growth. Gold deposits rise, treasury bonds gain attention, cash reserves balloon, and quiet movements into foreign currencies hint at the possibility that even the mighty US dollar may face turbulence in the years ahead. Meanwhile, the average investor continues to behave calmly. The markets have not crashed, headlines remain optimistic, government officials project confidence, and yet a shadow hangs over the financial world. The quiet, deliberate, and methodical repositioning of the wealthiest individuals alive. It's a phenomenon reminiscent of patterns observed before every major downturn. Before the dot-com bubble burst, before the housing market disintegrated, before the 2020 pandemic chaos rattled global systems. Data analysts tracking insider transactions find the numbers impossible to ignore. Over $50 billion of insider sales within a short period is not normal market activity. It is a signal that the people closest to the engine of global wealth believe the road ahead is far less stable than the public has been led to believe. Corporate insiders, especially founders, rarely sell when they expect strong growth. They sell when they foresee storms. They sell when maintaining their current level of exposure becomes dangerous. And they sell when they believe the narrative will shift before the data becomes obvious to everyone else. In Silicon Valley, the tone among elite founders changes. Private meetings that once overflowed with ambition now revolve around a different type of conversation. Risk management, capital preservation, and escape plans. The same minds that once raised billions for world-changing ideas now look for ways to safeguard what they have built. Wealth managers scramble to accommodate these shifts, creating new structures, trusts, and offshore vehicles designed to protect assets from whatever may come. In the real estate sector, luxury property listings surge. Multi-million-dollar homes that were previously tightly held by tech CEOs, crypto founders, and entertainment moguls quietly appear on the market. Some sell publicly, most sell privately. But the reasoning seems universal. convert assets into liquidity while valuations remain at their peak. Meanwhile, on trading floors, institutional investors watch carefully. When the ultra-wealthy move en masse, they pay attention. Banks revise their models. Investment committees quietly adjust their portfolios. Risk departments meet more frequently. Behind every calm news headline lies a scramble for interpretation. What if this is just the beginning? What if the wave of selling represents only the first chapter in a much larger story, one that will eventually reach the broader public only when it is too late to prepare? Global debt levels reach record highs. Corporate defaults begin ticking upward. Inflation, though cooled in some regions, remains volatile. Political uncertainty spreads across continents. Supply chain shocks continue to ripple unexpectedly. And technology, once seen as the engine of endless economic expansion, now shows signs of slowing under the weight of competition, regulation, and rising operational costs. To billionaires, these are not random headlines. They are signals, indicators, early warnings. They see patterns forming long before the rest of the world. They know that when liquidity dries up, markets behave like deserts, quiet one moment, deadly the next. They understand how rising interest rates weaken corporate earnings months before they reflect in quarterly reports. They know that when global uncertainty grows, capital must move stealthily into safer terrain. But more importantly, they understand human behavior. And human behavior, especially among investors, is predictable. When fear arrives, it arrives all at once. When markets crash, they crash suddenly. When liquidity evaporates, it happens in a single moment, not slowly, over months. And so these billionaires, these financial giants, these market architects, do not wait. They move early, quietly, efficiently. They protect their positions before the world catches up. The question that now hangs over everything is simple, yet terrifying. If billionaires are selling everything now, what do they think is coming next? And will the world understand the warning in time? Across global markets, a different kind of tension begins to reveal itself. Quieter than a crash, more subtle than a panic, yet unmistakably present. It shows up first, not in the headlines, but in private meetings, whispered conversations among analysts, and internal memos circulating inside investment banks. Something unusual is happening. Liquidity is tightening, credit markets are signaling stress, and the behavior of the world's wealthiest individuals, the insiders who understand market cycles better than anyone, is becoming increasingly cautious. When billionaires reduce exposure, it is rarely random. It is calculated, informed, and deeply strategic. Their actions signal not emotion, but anticipation. Private equity leaders who once bragged about expansion now talk about defensive positioning. Hedge fund managers reduce leverage, rebalancing portfolios toward safety. Tech founders who once declared their companies the future begin selling sizable portions of their own shares. Real estate tycoons quietly offload commercial properties at discounts rather than hold through an uncertain cycle. The volume is too large to ignore. More than $50 billion in assets shifted or liquidated in a matter of months. These moves are not symbolic, they are structural. They tell the story of a global financial elite preparing for an impact long before the public hears the first alarm. Inside boardrooms, risk officers present charts showing slowing corporate earnings, rising debt obligations, and increasingly unstable geopolitical environments. The world has entered a phase where every region faces its own version of volatility, economic, political, or technological. In such moments, wealth behaves differently than the masses. Ordinary investors are encouraged to stay invested and trust the market. But the ultra-rich operate on an entirely different timeline. They don't bet on hope, they bet on probability. And probabilities right now are not comforting. The corporate world feels the pressure. CEOs confront declining demand, persistent inflation, and rising costs of capital. Large companies can survive such pressures for a time, but small and medium-sized businesses feel the strain much more quickly. Bankruptcies begin to rise, not dramatically, but steadily. Lenders tighten standards, hiring slows, consumers pull back. It is a chain reaction that rarely stops once it begins, because economies are psychological organisms. They respond to expectation just as strongly as they respond to numbers. Meanwhile, billionaire investors scan global opportunities and see fewer safe places to park capital. Government bonds, once a sanctuary, now offer insufficient returns compared to inflation. Stock markets are overvalued relative to earnings. Real estate yields weaken. Emerging markets flash warning signs of instability. Commodities rise and fall with unpredictable momentum. In such an environment, holding too much exposure becomes dangerous. And so the movement continues. Assets sold, portfolios trimmed, risk shed. But beneath these surface-level financial decisions lies a deeper truth. Major shifts in billionaire behavior rarely reflect a single factor. They reflect overlapping worries accumulating into one decisive response. One such worry is the unprecedented level of global debt. Governments, corporations, and consumers have taken on obligations that exceed historic norms. Analysts warn that the system can absorb high debt only as long as growth remains strong. If growth slows, debt becomes a burden instead of a tool. Sluggish GDP numbers across major economies reinforce those fears. Another concern is the fragility of global supply chains. The world learned during past disruptions how vulnerable it is to shortages. Now, even minor delays ripple through industries that depend on precise timing. Manufacturing, transportation, and logistics face challenges that suppress profitability and raise costs. When supply chains weaken, inflation often follows. And inflation is one of the greatest enemies of long-term wealth preservation. Technology disruption adds yet another layer. Automation, artificial intelligence, and shifting consumer behavior reshape entire industries at astonishing speed. Billionaires who once rode the wave of innovation now question whether certain sectors have peaked. Venture capital deals slow, startups struggle to secure funding, and many unicorns see valuations collapse under the weight of unrealistic expectations. When valuations fall, the smart money exits early. Then comes geopolitical tension. Trade wars, military conflicts, diplomatic breakdowns, and shifting alliances create a level of uncertainty that fuels defensive financial behavior. Billionaires who operate globally see patterns long before they appear in mainstream analysis. Capital controls, sanctions, unstable currencies, and unpredictable regulatory changes. Wealth hates unpredictability, and the world seems full of it. The final layer of concern is consumer behavior. Across multiple markets, spending softens. Households feel the impact of high living costs, rising interest rates, and shrinking disposable income. When consumers pull back, companies' revenue declines. When revenue declines, profits shrink. When profits shrink, stock valuations fall. Billionaires track these micro shifts because they are early indicators of macro consequences. In this complex environment, the selling continues, not in panic, but in precision. A billionaire never sells everything at once. They phase out risk gradually, quietly over time. They distribute orders to avoid attention. They leverage private transactions instead of public markets. Yet when many billionaires take similar actions, patterns emerge. Banks notice it. Analysts notice it. Eventually, the public notices it too, though usually long after the smart money is already repositioned. As the selling accelerates, financial media begins to report unusual activity. Headlines appear. Major shareholders reduce holdings. Executives offload stock. Institutional investors rotate to safety. But these headlines tell only part of the story. The real story lies in the data: massive capital flight from risky assets, rising interest in cash equivalents, treasury bills, gold, and defensive sectors. Billionaires are not trying to predict the future. They are preparing for multiple futures. The psychology behind this shift is not pessimism, it is protection. Extreme wealth is built not only by winning big during booms, but by avoiding catastrophic losses during downturns. That is why billionaires pay attention to early warning signs that most people overlook. They understand that markets move in cycles, and every cycle contains a turning point. When the world's richest individuals collectively reposition their assets, it rarely signals confidence. It signals caution. Sometimes it signals fear. But this behavior also raises a critical question. What do they believe is coming? Some predict a major recession triggered by household debt and weakening consumption. Others see the possibility of a credit crisis driven by corporate defaults. Many fear geopolitical escalation that could destabilize global trade. A few worry about the bursting of asset bubbles inflated by years of cheap money. None claim to know the exact trigger, but all agree on one thing: the probability of something breaking has risen sharply. The public, however, rarely receives such information with clarity. Economic warnings are diluted by political messaging, softened by optimistic forecasts, and buried under daily news cycles. People hear that inflation is easing while simultaneously experiencing rising prices. They hear that unemployment is low, but notice friends struggling to find stable jobs. They hear that markets are resilient even as the smart money exits. The contradiction creates confusion, and confusion breeds complacency. Yet beneath that surface calm, the structural cracks widen. Economic models forecast rising default rates. Banks report declining deposits. Credit card delinquencies rise. Housing markets show uneven patterns, booming in some areas, collapsing in others. Retailers announce lower guidance. Manufacturing slows. Shipping volumes decline. The signals are scattered but consistent. Something is shifting. Wealthy insiders respond accordingly. They reduce exposure to equities, lower leverage ratios, increase liquidity buffers, and focus on preservation over aggressive gains. Some move assets overseas, seeking political stability. Others diversify into private investments insulated from market volatility. Many increase holdings in precious metals or commodities that perform well during turbulence. All these choices reflect a singular mindset: control uncertainty before uncertainty controls you. As the documentary narrative moves further into this critical turning point, one theme becomes clear. The world is entering a period defined not by collapse, but by correction. And corrections are often felt most by those who are least prepared. Billionaires understand that markets reward awareness and punish ignorance. They understand that wealth is never static. It is always moving, repositioning, responding. And now, more than ever, the movement speaks louder than words. It is a $50 billion warning sign written not in speeches or predictions, but in actions. Actions that suggest the next chapter of this story will reveal the underlying truth behind their decisions and what it means for everyone else watching from the outside. In the final stage of this unfolding financial drama, the signals grow louder, clearer, and far more urgent. What began as scattered moves by a handful of billionaires has now turned into a pattern, a coordinated retreat from risk, an orchestrated repositioning that suggests they see what most people do not. Money never shouts, it whispers. And right now, those whispers are growing into a storm. Across global markets, volatility becomes a daily norm. Stocks swing wildly, commodities spike, and safe haven assets inflate in value. Investors who once confidently rode the wave of growth now begin to question everything they thought they understood. The truth is simple and brutal. Markets do not break all at once. They crack quietly, piece by piece, until suddenly the entire structure collapses under its own weight. The billionaires, those who built empires on reading patterns, timing markets, and predicting human behavior, understand this better than anyone. Their sell-offs, their repositioning, their strategic exits are not acts of panic, but acts of precision. They are the first to recognize when an age of easy money is coming to an end. They are the first to step away from the table when the game becomes too dangerous. But the warning signs are not just financial. They are geopolitical, technological, social, and psychological. Supply chains continue to struggle under global instability. Energy markets fluctuate unpredictably. Nations turn inward, barriers rise, and the cooperative systems that once stabilized the global economy begin to deteriorate. AI automates industries faster than regulations can adapt, and beneath the surface, ordinary people grow increasingly anxious, sensing that something fundamental is shifting. At the center of this lies a troubling question. What happens when the people with the most information, the most data, and the most influence begin to quietly exit the market? What do they see on the horizon that the rest of the world does not? Some point to the rapidly rising levels of consumer debt. Others highlight the overvalued tech sector, inflated by unrealistic expectations and speculative frenzy. Another group warns of mounting sovereign debt, a burden so large that countries are now borrowing simply to pay the interest on the money they borrowed years ago. The world has become addicted to debt, and like any addictive system, the withdrawal is always painful. Meanwhile, real estate markets tilt into dangerous territory. Prices that rose far beyond wage growth now begin to fall. Commercial buildings empty as companies downsize or shift to remote models. Cities struggle as tax revenues shrink, yet expenses climb. Even luxury properties, once seen as a safe store of value, now face declining demand. Billionaires see this correction coming long before the average investor does. They step out before the wave hits, and in the shadows of all this, central banks walk a tightrope. Raise rates too fast, and the economy collapses. Cut them too soon, and inflation reignites. Every move becomes a gamble with massive consequences. The markets have become a delicate machine, too complex, too fragile, too interconnected to withstand sudden shocks. One wrong policy, one geopolitical crisis, one major corporate collapse, and the entire system could slide into a global recession. As this reality becomes unavoidable, the tone among economists shifts. Some warn of a soft landing, while others quietly admit that a soft landing is no longer realistic. Every major crash in history, from the Great Depression to 2008, was preceded by the same two patterns: overconfidence and silence. People believed the system was stronger than it truly was, and those who knew better said nothing until it was too late. Now, as the sell-offs continue, a final truth emerges. Billionaires are not just protecting wealth, they are preparing for a transformation. Money is moving into harder assets, private ventures, AI infrastructure, defense technologies, agricultural land, and commodities. These are not short-term plays. They are long-term bets on a world undergoing profound change. Yet, amid all this uncertainty, opportunity still exists. Every economic cycle brings both destruction and creation. While some sectors decline, others rise. While some fortunes disappear, new ones emerge. The market punishes the late and rewards the early. And right now, the earliest signals are sounding loudly. For everyday people, the path forward lies in awareness, understanding the patterns, recognizing the signs, and preparing before the wave hits. Crashes are not the end. They are transitions. But those transitions are survivable only when seen clearly. In the end, the $50 billion warning is not just about economics. It is about awareness, timing, and the quiet intelligence of capital. Billionaires are not selling everything because they fear the end of the system. They are repositioning for what comes after. And that is the true story. Not a collapse, but a transformation, a new phase of the global economy, a shift in power and wealth and technology and in how the world measures value. The warning has been given. The signs are visible. The question that remains is simple. Will the world listen?